Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is October the 18th, and I just want to begin by echoing the statement of the UAE government and as well as the United Nations in just the outrageous bombing, condemning the bombing of a hospital in Gaza overnight, where the UN have come out and declared, condemned it, and the UAE government has. And we echo that this morning in recognition that just some things are just too brutal to ignore. Good morning, and we are here looking at the oil markets. The oil markets have moved up above $91 a barrel, back into territory of the elevated levels, although we have seen in recent weeks we did get up to above 96 on Brent, and so we still haven't reclaimed that ground despite all of the geopolitical noise and sort of turmoil in the region. And let's kick off this morning with Kate Durian, the Meese contributing editor, non-resident fellow at the Arab Gulf States Institute in Washington. Kate, looking at the sort of growing geopolitical framework, the U.S. president due in the region today, your thoughts and outlook for this regional challenge, and is it going to, do you expect it to grow and have greater consequence for energy markets?
I mean, it already has had a consequence on the energy market. Prices have moved. I mean, initially they didn't, because it didn't look like it was going to. The noises that were coming from the countries that you fear might be drawn into it, I think, were quite measured. You know, it wasn't fire and brimstone. Now I think we're seeing a totally different. I think the hospital bombing might change the equation a lot, because it was so horrific. And I think for a while it was the horror at what Hamas had done, and I think now it's moving away from that. But it has polarized. It has polarized the world. I don't think Hezbollah has shown any great desire to actually actively engage. I think they're keeping it sort of, a few skirmishes in the south. But you never know when something is going to.
But it's also worth noting a former colleague of yours at Reuters was killed by an Israeli missile while covering that border only a few days ago.
Yes, but it's as the Israelis will say, it's war. There's going to be civilian casualties, but again, I don't think we still know what actually happened at that hospital. The jury is still out on that one, but and the fact that the US has sent these aircraft carriers to the region, I think, will probably deter countries. There's going to be a lot of talk. There's going to be a lot of declarations being made, but whether anybody has an appetite to actually get actively involved is another story. But I don't think there's a chance. For example, everybody keeps talking about the Strait of Hormuz is going to be shut down. Remind me when it was last shut down. I mean, there could be an attempt, but who's going to be cutting their nose to spite their face? Who suffers most if the Strait of Hormuz is closed? It's not going to be Saudi Arabia, it's going to be mainly Iran, Iraq. So I think the chances of the Strait of Hormuz, the chances that supply would actually be affected, unless there's something really, really, unforeseen, I don't think that's going to have much of an impact. I think so long as it's contained, prices are not likely to move, to 100 as people had expected. But I think it's just so unpredictable what might happen next that I don't want to make any predictions.
Dr. Charles Elinas, CEO, Cyprus Natural Hydrocarbons, and Senior Fellow at the Global Energy Center, Atlantic Council. With all of those job titles, Dr. Charles, you're well placed to bridge that Atlantic basin, if you like, connecting the Med with Europe, the Europe with the US and the Atlantic. Where do you see the perspective from Europe on this? It does seem like there's sort of a different voices. We've heard von der Leyen being, and most capitals in Europe being sort of profoundly supportive of Israel's position in the early days. Your thoughts on the outlook of this becoming a bigger challenge for Europe?
Well, first of all, Europe is a little bit sidelined on this. Even though von der Leyen went to Israel, she has been criticized by quite a few capitals for doing so without taking advice or reflecting European views. I'm sitting here in Nicosia in Cyprus, and Nicosia has been quite critical of that because right now people fleeing Israel and Palestine are arriving here in huge numbers. And it's felt that Europe is not having a coherent policy towards the situation in Israel. Even though it's making the news is all about the United States and what the United States will do and nothing about what Europe might or might not do. It seems to me that Europe has managed to sideline itself and unable to influence what is actually happening in Israel, in Gaza.
The situation in Europe is starting to feel like obviously there could be some ramifications and fallout. Let's go to Daniel Richards, MENA economist at Emirates NBD. Daniel, the region as a whole, the Gulf, etc., has had a very good sort of economic performance this year, despite some data out of Saudi showing a drop off in GDP with the lower oil production. But generally, your outlook for the region into the fourth quarter, with the shadows of all of this turmoil, the expectation for the Gulf economies to continue to perform?
Yeah, obviously, I'd like to echo your sentiments. First of all, have the awful attack last night, and indeed everything we've seen over the past week and a half really is quite awful. It's blown up to this degree once again. With regards to the impact on the GCC, as you say, like this year has been an extraordinary year for non-oil economies, at least, and any slowdown we're seeing in headline GDP, that is largely or entirely on the back of the voluntary oil production cuts. Obviously, hydrocarbons economy is still very important in the region, so voluntary cuts equal slower GDP growth. For non-oil GDP, the outlook is still pretty bullish. I think that was underlined by what we saw this week in terms of the data. Dubai in particular, strong first half GDP growth. Second quarter is at 3.6% year on year, and we'd expect, as it stands, our forecast for the whole year is a 4% growth in Dubai, and the expectation of stronger H2 growth. That is largely on base effects. In terms of quarter on quarter, we were already anticipating a bit of a slowdown, and what we're seeing now in the wider region does raise risks to that. Every time Middle East conflict flares up, it does perhaps deter some visitors to the region, and tourism really has been the key driver of growth in Dubai, not only through the direct effect of hotels and transport, but also the pass through to construction and real estate and everything really. So it is important. As it stands, we would expect it to remain fairly contained. As Kate was saying, there has been the initial kind of saber rattling, perhaps hasn't been followed through, thankfully, to date by anybody, but more instances of the kind that we saw last night, that tragic event last night, does raise tensions, does raise the risk that this does escalate. And of course, if that did blow up into a wider conflict, that would have very severe effects on GCC economies.
Kate, looking at the fundamentals here, I mean, as we go into the fourth quarter, we had all of the expectation and despite the sort of price correction pre the tragic events in the Eastern Mediterranean, and that the outlook for the fourth quarter was built on fundamentals of supply shortage and relatively robust demand. Does that continue to be ultimately the foundation of this market?
I mean, I think we all expected that the first quarter of next year, and I think the question was, is Saudi Arabia going to be extending its voluntary cut? I think if we knew that, we'd all be very rich because they like to surprise us. But I think the expectation is that there will be a surplus in the first quarter of 2024, and it won't be coming from OPEC plus. It's going to be non-OPEC. It was going to be Guyana, even the US. So I think if the predictions of demand growth slowing in the first quarter, then I don't see any justification why OPEC plus would extend the cuts. I mean, don't forget there are new baselines coming and new quotas coming in January. So we kind of have an idea of where OPEC plus is going to be. What we don't know is whether Saudi Arabia will again spring a surprise. But I think in times of tension, do you want to pour more, fuel on the fire? Who knows? I think that's been the whole policy of the Saudis, is sort of spring a surprise, keep the market guessing, keep the speculators guessing. So I don't see any reason why they should change that policy. But if there's going to be a surplus, then the important thing is stocks. They look not just the price, they look at global stocks. US stocks are pretty low. They need to be refilled, and they're not going to be refilled at higher prices. So that's also a bullish factor.
Dr. Charles, we do have those sort of underpinnings. We have the Chinese Q3 GDP growth coming in this morning at 4.9%, a little bit higher than expectation. Despite all the macro headlines, China continues to grow and the demand centers continues to import solidly over 11 million barrels of oil a day. Your thoughts on that demand side holding up despite the macro backdrop?
I think the demand is going to carry on growing. I mean, all indications is that the demand curve is trending upwards, despite the fact that the IEA is trying to cast some doubts. I mean, in a report just released, the IEA says that it sees early signs of demand destruction. Looking at the graphs, it's difficult to believe that is where that is coming from. I mean, the IEA says that global demand will grow by 2.3 million barrels per day this year, but only 0.9 million barrels per day next year. I'm not so sure. I think the IEA is doing everything it can to demonstrate that fossil fuel consumption, both oil and gas, is going to reach a peak, but none of the real indicators supports that. It's almost as Saudi Aramco said, the IEA is on a political campaign to drive oil and gas consumption down, but without actually succeeding. In both, I mean, the EIA, the Energy Information Administration, released a report only just recently, and it claims that natural gas demand will carry on growing to 2050. And as you know, OPEC expects oil demand to carry on growing. And in reality, all signs we see so far support these views that there is going to be growth both in oil and in gas demand, simply because the promises made by renewables are not actually materializing. Renewables are still facing problems, even though the use of renewables is increasing. It's not increasing at the rate to cover the increase in global energy demand. So for all of these reasons, I believe that oil demand will carry on increasing for a while yet.
Daniel, meanwhile, with all that's going on in the world, in China, the Belt and Road Forum is taking place in Beijing, and on a very rare occasion, President Putin of Russia is outside of Russia and visiting at this event, sort of consolidating the position and relationship between Russia and China, and also sort of doubling down on the Belt and Road sort of project, which is 10 plus years now in the making and then had gone through a few wobbles. Where do you see the economic outlook for the Belt and Road Initiative in order to drive economic growth across Asia, the great promise and still the Chinese aspiration to achieve that?
Yeah, as you say, it has gone through some ups and downs over the last 10 years ago. But I think the fact reform is going ahead and we're seeing the headlines indicates it remains a key policy objective of the Chinese government, both from an economic standpoint and, of course, from the more material power play that it helps them build up through the Asian region and helping, in terms of trade corridors, open up new trade corridors that might not be more secure than others, and it's generally boosting regional trade and their influence. In terms of the outlook for it, obviously, the slower growth or the more disappointing growth and the kind of questions over the durability of the Chinese economy that's starting to come to the surface more this year. Not only the near term, they haven't seen the kind of short-term stimulus that we might have expected in this position growth. Okay, we had the upside surprise today, but it hasn't really been as robust as expected. But also the kind of questions we're seeing over the longer-term growth projection for China in terms of demographics and the rest of it. So I think making a success of it is becoming ever more important, but it's becoming ever harder for the Chinese economy to manifest, especially with, you have started to see pushback from some countries in terms of the so-called debt diplomacy and all the rest of it. So I think it's a more challenging outlook perhaps when it was launched, but it still remains a center point of their objectives.
Kate, at the same time, we have the Belt and Road Forum in Beijing. We have the big event on the annual calendar in the oil industry in London, what used to be Oil and Money, now the Energy Intelligence Forum, where all the world's biggest CEOs in the oil and gas industry tend to rack up and share some thoughts. We have the biggest of them all, the CEO of Saudi Aramco, saying oil markets are in balance despite the weak backdrop. Has OPEC called this one right? Ultimately, I mean, not OPEC, ultimately Saudi. OPEC had called a plus 3 million barrel a day supply deficit. We have the Aramco CEO saying the market is in balance.
Yes, I think they did get it right. I mean, everybody expected that prices would shoot up if they decrease their production. It didn't. We've seen a bit of volatility. We had seen a bit of volatility, but not as much as we saw in the last 2 weeks. But I need to defend the IEA. I'm sorry, but we're not. I mean, I say we because I was there. We're not political when it comes to data, when it comes to actually looking at demand, supply-demand balances in the oil market reports. So I think sometimes the messaging can be a bit sensational by my former boss, but I don't think it's designed.
The IEA had called a deficit of 1.5 million barrels a day, supply deficit for the fourth quarter, which could indeed still be the case.
Yeah, exactly. But what I mean is that, we go by the numbers, it's not political. And as I said, sometimes you do get these sort of sensational headlines and op-eds by Fatih Birol, but the data itself is non-political because, it's there in the database and that's what we're looking at. But yes, I mean, I saw what Nasser said. He said there's going to be, if we don't invest, we're going to have a deficit of between 4 and 5 million, which is natural decline. And in fact, at your excellent Fujairah forum the other week, we were talking about Russian oil industry and how it really hasn't been impacted by the sanctions. They're still exporting, they're still managing to produce. It doesn't look like there's going to be any lasting damage to Russia's industry. So I think they're.
But the other thing that Amin said, which I thought was interesting, I'd welcome your thoughts on it, Kate, was he highlighted the fact that there is increasingly greater amount of idle capacity, extra capacity, spare capacity in the oil markets, 3+ million barrels a day, nearly alone in Saudi Arabia. This should be a very bearish signal for the market in regards to any sort of threat to supply.
But that's been the case since they cut supply. It's not anything new. He's just saying it. He's putting a number to it. There's actually more because if you look at, other countries, if you look at the UAE, for example, they have, a lot more spare production capacity. Iraq, if the Kurdistan pipeline opens, you'll have another 500,000.
But maybe perhaps that's why we're not seeing such a big pop-up in the price on the back of the crisis in Palestine, that due to that there's so much idle supply at the moment that it would take a major disruption for anything not to be able to be covered.
Yeah, but let's not forget that's not going to. I mean, he says they can bring it on, pretty quickly. But how quickly? You can't just open the tap. So that takes time. It takes time to ramp up, to sort of maintain a production at a certain level. So it's not like tomorrow. But yes, it's always been. It is a bearish factor. The other thing is, I think one of the biggest impacts that might be is people are going to start looking at the region thinking, do we really want to invest in a region that is so volatile? Depends, of course, on what happens in, Israel, Hamas, the whole thing. But I think it's now the Middle East is being tainted as, is it safe to go there? Is it safe to fly there? We've seen, two gas fields in the East Med, which is supposed to be, the new gas hub, security for Europe, etc., has been shut down precautionary, but it just shows how you still have this fear of energy infrastructure in the Middle East being a potential target. We've seen it before in Saudi Arabia, we're seeing it now. Gas supply to Egypt has been cut. So I think gas, as I keep saying, gas is actually a more important story at the moment. Because if we get a cold winter, it's going to be really, really hard to find the extra supplies. And let's not forget that when oil prices shot up in 2022 after the Ukraine invasion, we saw a lot of switching oil for gas, which we probably won't see at this time. So it's it's a very volatile situation.
Dr. Charles, we also had in London at the Energy Intelligence Forum the Vitol CEO, who was more or less echoing the Saudi Aramco CEO that the oil markets are in balance. But as Kate said, I thought was possibly more interesting, and a comment he made, which I'd welcome your views on. He said sort of permanent demand destruction in Europe, sort of gas demand destruction in Europe due to the energy crisis over the last year. Your thoughts on that and what that means for the outlook on gas?
I mean, I agree with that. It seems that the main drive for this demand destruction is the inability of the European industry to recover. German industry, especially heavy industry, is moving out of the country, and I think that is permanent. And Germany is going to be that much smaller in terms of industrial output than it was before as a result of high gas prices, which continue. So I agree with that. It's Europe is going to see permanent gas destruction, and all of these things we hear about Europe needing much more gas for this reason or for another are not going to prove to be right. I think in the longer, I mean, we had some results published by European Commission just now showing that based on last year, this year's gas consumption in Europe was 17% down, and that is expected to continue. I think gas with Repower EU, the European policy for energy targeting a 30% reduction in gas consumption by 2030, it seems to be on the way to achieve that. And that gas use in Europe will carry on going down towards 2050, at least that's what Europe is targeting. And they seem to be going in that direction, I think for the wrong reasons. I mean, the reduction in gas demand in Europe is not because renewables are taking its place, it's because the industry is going down. And that is a very unfortunate development following Ukraine. And I don't see that recovering. European policies towards industry are incoherent. They are not going far enough to support the industry, and the industry is not getting the cheap energy it needs to continue thriving as it was before. These are the problems Europe is facing, and I'm not so sure it has yet produced a coherent policy to face these problems.
Let's go to the survey question. Again, just looking at this, what is having the greatest underpinning for the $85, $90 oil market? China demand, despite the headlines, continues to be quite solid. Saudi unilateral cuts we've talked about has clearly been a game changer in the markets this year. The geopolitics that are undergoing, obviously the war in Ukraine, now the war in Palestine, or none of the above. What is having the greatest underpinning for $85, $90 oil market? All of the above, obviously, I didn't put there, but which do you think is the main pillar that gives this market? Obviously, the market was already enjoying lofty heights just before the recent geopolitical crisis. But where do you put the main underpinning? Daniel, the main underpinning could be in the Saudi unilateral cuts, but the consequence of that, of course, is that the Saudis' GDP numbers are down for the year, given the loss in revenue, lower oil price, lower oil production. So the combination of both on the average for the year is less than in the Saudi. And I'm wondering, from Emirates NBD Bank's analysis on the outlook for the Saudi economy with this massive ambitions, will they have to curtail them in any way given this decline? Obviously, last year was an exceptional year. You can't expect that every year. But where do you see the impact given the massive ambitions that Saudi Arabia currently has?
Yeah, I think for the time being, those ambitions remain in play. Maybe they won't be manifested quite as swiftly as they might have hoped. Headline GDP there is going to be weaker, but like I said earlier, the non-oil sector is still looking pretty strong, and not just in terms of those headline-generating investments, but in terms of like the general ongoing growth in various sectors there. Budget, we do now expect a modest budget deficit this year, down from a surplus around 2.5% of GDP last year. Expect deficit now of around 0.5% of GDP. So it's not something that's overly worrying at present, and we've seen the oil price tick back up. Obviously, it's a moving part in terms of the break even if they're cutting production as well, right? So that changes, but I don't think it's overly concerning as it stands. But obviously, from a long-term basis, they can't be doing those plans if oil falls back significantly lower, right? But as things are presently, I think they're still in quite a comfortable shape, even if budget surplus isn't going to be what we expected this year.
Kate, last word to you. What the President Biden coming to the region today. It appeared the big summit with Egypt, Jordan, and the Palestinian leadership, Palestinian Authority leadership meeting seems to be falling apart given the backdrop. Can they move the dial on this in any way, do you think, to change the trajectory? President Biden does seem to be putting all his eggs in this basket. For an American president, high-risk poker.
Yeah, I think it is, and that's what I meant about, it's been very polarizing. Suddenly, the Americans who have sort of took their eye off the Middle East are playing superpower again. But one of the reasons why the rise of the other powers, the Asian powers, is partly because America took its eye off the ball. Now they're back, and I think it's. I mean, the risk of radicalization everywhere. I think MI5 has said it, US intelligence has said it, because it's just inflamed so many passions on both sides in Europe, across Asia. So, and let's not forget, we're talking about Saudi Arabia, Saudi economy, the Gulf economy. They've got enough in their coffers, they can withstand it. But look at countries like Egypt, which is really, in a really bad way. Inflation is 39%. So it's you have to look at the region as a whole, which is in a bit of a mess at the moment. So, but I just wanted to say, Charles, when we were talking about Europe, yes, obviously Europe does have very, very high targets and high ambitions. But one of the reasons why gas was down in Europe was because they were burning more coal. I mean, that's a reality. So the transition is moving, but I'm looking at numbers here, and it's really quite frightening. With all the big solar projects that we have in the UAE, the percentage is still pretty, pretty small when you look at it globally. But yeah, I think we're in for a volatile period. How prices are going to react, I don't know, but it doesn't look like this is going to be over soon. And even if it is, I think we're going to feel the consequences of it for a long time to come.
Well, with that note, we will wrap up the Daily Energy Markets podcast. Brent crude oil trading at 91.35. When you consider all of the context and all of the issues we've touched on, it does still seem like a relatively calm oil market despite the backdrop. Thank you so much, Kate Durian, for your words and insights today. Dr. Charles Elinas in Cyprus and Daniel Richards at Emirates NBD here in Dubai. Thank you so much. We'll see everybody every morning, 10:30 UAE time. All the best.
Bye.
Bye-bye. Thanks.